Yes, yes, yes. You are locked into another episode of Money Matrix. I'm your boy Seb, aka Sebuh Mesfin.
Yes, Seb. I am Mickey. I don't know if I should drop an AKA. I'm just gonna say
You're not
AKA
gonna give
Mickey.
You know what I'm saying? Mickey's only Mickey, the one and the only. And we're back with another episode today. And what we doing?
So much to talk about. So much, but stock market, man.
Stocks. We talked about VC. We've talked about central banks, inflation. Now we're getting into stocks. We talked about the nitty gritty. You would have seen one of our previous episodes on YouTube, how to invest your first £5,000. A lot of people asking us about that. So one of the things that we talked about was investing long term in the stock market, S&P 500. But we thought, let's actually break it down. Like, what the hell is a stock market? When did it begin? Like, let's go quick deep dive into the history, and then we can talk about all the different stock markets and just give people a bit of nice information that they didn't know that they needed.
Love to hear it, bro.
Boom.
Let's do it.
So let's start off with a little historical segment, yeah?
All right,
we're all very much used to the stock market.
Young historian, we love to hear it.
Believe it or not, the stock market hasn't always been there.
Okay.
Yeah. The first stock market that was ever started was in the late 1400s in modern-day Belgium. And it was because merchants were buying goods, anticipating that prices will rise in order to net them a profit. So essentially, they created like a trading sort of market, what you would essentially refer to it as a modern-day stock market. Mm-hmm. The first modern-day stock trading was created in Amsterdam. The Dutch East India Company was the first publicly traded company. Yeah, hold tight you. I know you got a bit of a history in Holland as well.
Come on.
The late 1700s, a small group of merchants made the Buttonwood Tree Agreement. This eventually went on to become the New York Stock Exchange. So the New York Stock Exchange, the big famous one, Wall Street, that was in late 1700s.
1792 to be precise.
Okay, there we go. And then 1896, the Dow Jones Industrial Average was created. It initially had 12 components that were mainly industrial companies. 1923, the early version of the S&P 500, which we talked about as something that you should look at investing, was created by Henry Barnum Pause Company, Pause Publishing. I wonder if that goes on. Is there like a Pause and Moody or Moody and Pause, or am I?
Pause, yeah.
So
Standard and Pause.
Standard and Pause. So that's where the S&P kind of name comes from. Mm-hmm. And then
S&P.
It begins tracking 90 stocks in 1926. So the S&P, I guess it wasn't. It must be the S&P 90. Yeah, it would have been the S&P 90 was started in 1926, and now we've got the S&P 500, which includes the 500 largest stocks by
companies.
Market cap. Yeah, by companies by market cap in the US. Cool. 1929, the US stock market crashes after the decade-long roaring 20s. This is when we had the Great Depression, which was crazy. You've seen all the videos in black and white and images of people. Yeah, wild times. And then I guess in 1971, trading begins on another US stock exchange, the National Associations of Securities Dealers Automated Quotations, also known as the Nasdaq.
Come on.
Nasdaq.
The tech gang.
And then 2008, stock market crashes after the boom and bust of the housing market. We were there, we were live, we saw it. It kind of sparked our interest.
That's where we began, bro.
That's where Money Matrix actually began, right?
That's literally where Money Matrix began, man. Them documentaries
chilling on the block like a low life, talking about what's going on in the sort of market. Yeah. Why are they taking EMA away from us? Why are all these things happening? That was all linked to the stock market crash of 2008. And then we have 2020, COVID-19 pandemic, and the stock market sees a large decline. But then it also saw a bounce back, which we're kind of seeing right now. So that essentially rounds up the little historical segment of the stock market.
Nice. Whistle stop tour.
Yes, whistle stop tour. And another sort of interesting part is the history and now the geography of stock markets.
Yeah.
there's more different stock market. People don't really know this, but there's different stock markets across the world.
Yeah.
I recently heard one in Jamaica, actually, in the Caribbean, as actually one of the fastest growing stock markets and places to invest in for sort of like high growth kind of companies. That was quite interesting. Are there any other stock markets that you find interesting, or any other ones that people might not know about?
Yeah, I think there's stock markets literally in so many geographies, and you know, you got ones in, say, across Europe. All of the European countries have big stock markets, whether it's in France, Germany, London. We've got the London Stock Exchange.
Yep.
So you've got stock markets around the world in Hong Kong, Japan, and usually, right, like they are the companies of the country, and that's where their stocks get traded. So you've got stock markets in most developed markets and also emerging markets too. That's becoming a big thing. Even in Ethiopia, where you and I are both from, they've got a stock market now that's like they're starting to build that out. It's not as, you know, robust or resilient or historically as long-standing as any of these markets we've already discussed, but it shows you like it's a thing that's around the world.
Yep, and I guess stocks is one of the many different markets. Is commodities, does that count as a stock market, like a commodities or future exchange kind of thing, or is that a different something?
Yeah, so it's stock refers to a very specific thing, right? A stock in a company, an equity in a company. But you have markets where you are able to trade assets.
Yeah.
Right? So you've got commodity markets. So you can trade anything. You can trade sugar, heating oil, you can trade gas, you can trade potatoes, you can trade timber.
The future weather.
You can trade pretty much loads of... So commodities are actually a big part of the trading market.
Yeah.
They are like a substantially traded product. And there's various types of commodities.
I heard that.
Coffee, oil, across everything.
Stock market. So stock markets refer specifically to the equities in a company.
Yes.
It's not a product like sugar or rubber. It's not a commodity. It's actually part of the company. It's equity within the company. Now, question. Why would a company want to go to a stock market? How does a company even get into a stock market? What's the journey like?
Yeah, so like last episode, right, we talked about venture capital funding.
Yes, we did.
Right, and like to kind of like summarize it in short terms, right? Venture capital exists because that is a business opportunity where folks with a lot of money, right, can say to someone who has a great business idea, all right, we'll fund you and we'll get something in return because we see the vision, right, over a long term. Now, when you think about venture cap, right, there is only so much money you can put into these companies.
Yes.
Right? So the biggest, most recent venture cap investment that I can think of was Stripe.
Yeah.
Right? Huge payments company. They raised something close to $7 billion, right? But you don't often hear that happening. And you, of course, you get some of these big companies with what is known as like mega rounds, funding rounds, where you get big amounts of money. But at some point, private hands can't really fill the needs of these big companies in terms of funding. So that's why companies go public. Essentially, when you go public, what you do is you sell a stake of your company for cash right now.
Okay.
And that cash right now is what you use to build your business over a long term. And the idea is once you are going public, you are very close to, or you have a very clear trajectory in terms of making revenues that are fast growing, but also profits. Right, so the company is essentially now a pretty big company that's making good money, and it can kind of sustain itself. It doesn't need like frequent injections of capital from investors. And so you go public where you get a large tranche of money in one go, right? So
a good example, actually, one that's recently been happening is ARM IPO. So there's a company called ARM. We were talking about Mayoshi-san actually in one of the previous episodes. Crazy Japanese investor who invested in Alibaba and got like a 2000x like return, and actually set up one of the biggest, I think it is the biggest venture capital fund in the world, SoftBank, Vision Fund, and one of the companies...
the second Vision Fund, I remember, was like 100 billion.
It was 100 billion. 200 billion. Yeah. That's another story for another day, because the Arabs are getting involved in that. And we'll do another deep dive, actually. We might need to do an episode on Mayoshi-san, because he's such an interesting character. But the most recent company that's been in the headlines is ARM. Now, they bought ARM. It was previously, if I'm not mistaken, was it a private... It was a public company, and they bought it and they took it private. So...
Is that the case? I don't know, actually. I'm not... I think it was a... It is, yeah, you're actually right. It has a pretty long history, and that... So think a bit like Twitter.
Yeah.
Right? Twitter was a public company.
Mm-hmm.
Elon buys it.
Yeah.
Takes it private.
Yeah.
Why do you take a company private? Because once you go public, you have, a huge amount of shareholders, right? You can have anyone being a shareholder.
Anyone can buy into it through the apps.
You've got to appease the shareholders.
A lot of regulation, a lot of reports.
On what you can do, right? So if you go private, right, that gives you a lot more freedom to drive the company's direction. And the idea is, in the long run, you think you'll be able to deliver way bigger results for that company and increase its valuation by a significant fold. So that story with Arm makes sense.
Exactly.
Too, that
so
they were, either a private company.
No, they were. So they were on it. So essentially, what happened in 2016 was that SoftBank and Mayushi Son took Arm private in a deal worth $24 billion. Interesting. And now what they're trying to do is they're trying to take it public again for an apparent $64 billion. So they're going to triple. They're essentially 3x in that. And it's 3X. It's been 7 years.
The thing is, it doesn't sound like 3x doesn't even sound like that much money, but it's like 40 billion in 7 years. That is insane.
But check this, they're only going to list 10% of the company on the stock market, which is very interesting. So you don't even have to list all of your shares on the kind of stock market.
You don't.
Now, why would they only list 10% of the shares? They think that it's got even more value to kind of give. And I guess they're trying to raise some capital to help it in its growth.
That's one part of it. The second part of it too, right, is that by listing only a kind of fraction of the company, you retain more control, right? So lots of the times, like you see with companies, what they do often is they have two different types of shares, right?
Yeah.
So you've got like Class A shares, like preferential shares, and Class B shares. Usually what this means is if you have let's say Berkshire Hathaway is a good example, right? The Class A share for Berkshire Hathaway is insane. It's like 500k for one share.
Wow. Just one share?
One share of Berkshire Hathaway. But it's like they don't have that much of it.
Yeah.
The company is valued at what, 500-600 billion? But one Berkshire Hathaway share is like 500k. It might be more now. But basically, essentially what it means
540 grand.
540 grand. But, and how much is a Class B? It's like $500 probably. Something like that.
Let's see. Class B, 707. Wait, no. Let me get the right amount. Class B, I think $350.
Yeah, so it's not that much. But basically what it means is usually like Class Bs, right? Like if you have a Class A and a Class B, a Class A gives you voting rights. It gives you a lot more power to determine the direction of a company.
Okay.
Now, if Mayushi Son owns, say, 90% of the voting rights, he's got a lot of protection from shareholders demanding that Arm does this or that when they're not enjoying the results or when they want it to go in a different direction.
Yeah.
So that's one of the reasons why you also want to kind of maybe list only part of your company, right? Because you get the best of both worlds. You get some control over your company, but you also get liquidity injection that can help you grow that business.
But that being said, there are some essentially do's and don'ts, and people will look at you, investors will look at you a certain way if you're listing your Class B shares instead of your Class A shares, and you're not actually giving some sort of meaningful control to the wider public. And that's where someone like an activist investor might step in and try to buy a certain amount of shares to give them, I guess, some sort of like voting right. But question, we're talking about stocks and shares, right? Arm, for example, they were a British company. They were founded in Cambridge. They are a Cambridge, but apparently they're going to get listed in New York. So how does that make sense? Like, why would you list something in a different country? Like, what's up with that? You've got the New York Stock Exchange. You've got the London Stock Exchange. What's the one in, is it Shanghai or Singapore?
You've got Hong Kong.
Yeah, Hong Kong. Why would a country that has been created in Britain want to list themselves on an American stock exchange?
Yeah, so there's like a number of reasons for it. One is to do with how much money you'll get, right? So think about Deliveroo, right? Deliveroo and Wise, right? Two big UK tech companies that listed and their stocks just got beaten up since they listed, right?
Yeah, it got beaten up a lot.
And basically, it's about the market.
They sunk 31% after the IPO.
Who's that? Delivery.
Yep.
exactly.
On the debut, literally on the
Imagine,
first
just on
day,
the IPO,
literally on the
right?
first day,
That's mad.
it dropped by 30%.
It's huge amounts of money, and I don't even know if they're like necessarily up since the IPO even now.
No, they're not.
They're still down, which is
they're
wild.
still down.
But the reason, like, okay, so actually a funny story is that, you know, you've come to my show that we do, the event we run, and one of the speakers we had this year was Julia Hoggart, who's the CEO of the London Stock Exchange.
Mm-hmm.
And one of the big issues actually in the UK financial system right now, right, is how can London especially make itself more attractive for companies to list themselves?
Yeah.
Why are all of these homegrown companies listing themselves in the US? So the first is the US is a super attractive market. There is so much liquidity, and there is such a big investor base, right? Not just from a numbers perspective in terms of 300 million or whatever people in one geography, one regulatory jurisdiction, but also things like the amount of money there is in the US stock market, right? That's so huge. It kind of dwarfs anything else there is around the world. So there is a lot of capital that a company can tap into.
Yeah.
The second is valuation wise, the US companies in the US, especially tech companies, have garnered way heavier valuations. And that might be to do with a number of reasons, right? So in the UK, investors might not have the same cultural outlook or perception.
Exactly. Silicon Valley has been a strong component of the US economy, and
more than that, Silicon Valley is like now like the US economy to a degree, right? Like everything is like
Google, Apple,
actually, if you look
OpenAI
at like
now.
recently, right, like the stock market, the S&P, we talk about S&P 500 and the Nasdaq, right? These are benchmark markets. Essentially, they track the predominant state of the economy, or the companies in that economy, right? And lots of analysts are saying like the tech market might save the US stock market right now, because if you look at like all the banks, they've been beaten up. The energy firms, they had a good run recently, but they're getting beaten up. Fast moving goods beaten up, retail getting beaten up, right? Like Foot Locker 2 days ago dropped 35%.
Mad.
Like
Crazy.
Imagine 35% in valuation one day, right? So, but look at Nvidia. Nvidia got like 100 billion in its market cap like 2 days ago because it just smashed its. And so tech companies in the US have such a favorable perception amongst investors there as well. You're gonna get more money by listing there, so why not?
It's actually crazy because Nvidia recently crossed the $1 trillion market cap. So I can see why ARM would even want to list in America, because
especially because that's what they do too. They're a semiconductor firm, right?
Yep,
like
that's
they create these things too. So absolutely makes a lot of sense why you would want to go list in that market. And also because one of the things you've got to think about is the value of anything, right?
Yeah.
There's more nuance to it, but value doesn't exist without comparison.
Yeah.
Right? Like, let's say you're wearing Air Forces, I'm wearing Dunks, right? The prices are a comparative thing. And then if someone's got a Reebok, someone's got Adidas, right? Like it's comparative. You base it. And then if, let's say you had
someone's got the Adibas.
But now imagine you got like some, but you understand my point, right?
I get what you're saying.
And so if that's how value is generated often, right? It's a comparative thing. Then you're going to want to operate in a market where you've got a lot of peers being listed, because then when, let's say Nvidia does amazing in its quarter, right? Like as it did recently. I mean, their results were astonishing. Yeah. Their revenue went up by like 80% or so. Quarter over quarter. Do you know how insane that is
for a big company,
30-year-old company to just add on $5-6 billion in one quarter beyond what it would?
I saw
they went from like anticipated revenues of 12 to 16 billion.
Yep.
Do you know how much of a huge monumental
it's
but
mad.
when Nvidia does that, right, what happens is it's like the rising tide. All of the other companies rise with it too. Now we'll be able to track that. Obviously, there's pitfalls too, right? If do you get what I mean? But what it means is essentially it kind of allows you to not just compete on your own, but compete within the broader kind of context of the environment you operate in as an industry player, and not just limited to your geography. Like
facts.
So that's the reason I would say.
Facts. So we've gone in on the stock market. we've given you the lowdown, the knowledge, the surface knowledge. Are there any conspiracy theories around the stock market? Let's take like a wider look. You know what the money matrix boys. You know we like to give you the other side. For me, my problem with the stock market is that it's all based on perception and confidence.
100%.
If a group of people start pulling their money out of a certain company because they've got some information or they perceive it to be a certain way, then a lot of times the market sort of follows and withdraws money from that sort of company. And through no fault of the company sometimes, they can lose like half of their market share. I think
way more than that.
Yeah, way more than that. I think what we saw with the Wall Street bets, the meme stocks, that was a great example of like just the fallacy of the stock market and how easily it can kind of be manipulated. Especially now with how fast-paced social media is. We saw that social media essentially took down one of the companies. It was a hedge fund actually. A hedge fund was shorting GameStop, right? People got wind of this on the internet and they started boosting up.
Yeah, so that's what's known as a short squeeze. Yeah.
Yep. And then what happened?
So the hedge
they
fund
squeezed. They literally blew up.
Yeah.
I think the guy was some Australian dude or something like that.
I actually think a lot of hedge funds have been hurt recently by the retail investors. So it's not just GameStop, it's AMC, the cinema company in the US. More recently, the other day, Tupperware, like the brand that makes the Tupperware thing, they're going bankrupt, but
it's crazy.
They had a huge short. So wait, let's go back a second. What is a short squeeze? Right, we were talking just so far. We've been talking about buying stocks.
Yes, buying stocks
to invest in a company, right? Now
the other side.
There's another side to
the dark side. The dark arts of the stock.
It's actually the dark side. It's literally like, and part of it, this is why the stock market is interesting to a degree, because there is a part of it where, because of the kind of adversarial parts of it, and because there's so many competing parties in it, stock markets are seen as quite efficient in terms of price discovery. Essentially, it says like, if lots of people are buying and trading and lots of people have different information, their assessments, right, it will create the most efficient pricing. And one component of that is short sellers. What is a short seller? A short seller basically is someone or an entity that tries to benefit by betting against a company's growth or performance. So let's say Nvidia, right? Let's say we've been talking about it. It just crossed over the $1 trillion mark, right? But let's say I'm a short seller and I think AI is overhyped. I think Nvidia might be good right now, but they don't have the right strategic framework, long term, whatever it might be, the right leadership, right? What I will do is I will go to someone who owns that stock, right? And the market exists so that I don't actually have to find an individual person. But in theory, what goes is, let's say you own 500 shares of Nvidia. And I'll come to you and say, Seb, can I borrow 500 shares of Nvidia from you? And I'll pay you a fee for borrowing that loan, right? And then we create an agreement. We say, all right, and you say, all right, you've got to give me this stock back in a month, in 5 months or whatever, right? For you have your stocks, you bought them, you've got the value, and you're getting paid to lend it to me. Now, why would I want to borrow the stock from you? I would want to borrow the stock from you because I believe that stock is going to go down. So what I do is I borrow it from you, I wait, let's say, and it goes down. When it goes down, I buy back the stock at much cheaper price. I give you your stock back and I net the difference. So that's what short selling is. And often short selling is an important component of the stock market because it weeds out things like fraud. So the most recent story that I can think of is Block. Right? So there's Hindenburg Research. These guys are ruthless.
If Hindenburg Research is on your case,
you're done. You're done.
Nah. Just know that you're done. Just Google these, man. See how many companies that they've taken out of the stock exchange and be shook.
They would literally. So what they do essentially, they're a research. It's so weird. I love the stock market. One of the things I love about the finance industry, right, is if you look at the companies in it and what they are labeled as, doesn't look like what they do. So Hindenburg Research, right? It's not. It's like you think it's a research data fund, but basically what they do is they do research. They dig into a company and they try to find discrepancies in a company. And then with those discrepancies, they're like, all right, you know what? We think this company is not being accurate, faithful, honest with its reporting, its numbers, And then they'll create a mad set of kind of supporting documents, because you can't just be out there just sending for man like that. You've got to have some evidence. But once they do, and if you've got the reputation as a short seller with some credibility, you literally, as soon as you say this company's done, it will go down 50% minimum. And that's what happened with Block. I remember I was actually, not gonna lie, I was personally hurt because I'm a big fan of Block as a company.
I bought their stock as well. I'm not gonna lie.
I still hold stock.
I still hold it, but
I was, I was talking to my girl, and we talk about investing, and one of the companies that was on our list to invest was Block.
Yeah.
And we just bought a little bit, just a couple of shares.
It's owned by Jack Dorsey, right? Jack Dorsey is the founder. He was the
founder.
co-founder.
He's the CEO. It's a public company, but he is the CEO.
Former founder of Twitter, I guess, is owning that.
He is still the founder of Twitter.
He
founded it. Once he founded it, he can't be, but he's the former CEO of Twitter. But basically what happened was we literally bought it, and it was like $75, whatever, $80. Like 2 days later on, the Hindenburg research came. I didn't even need to look at the price.
You just knew it was.
I was like, God damn, God damn. But that's what short sellers do, and they create. But to go back to your original point too, the stock market is wild because, as you said, it's a perception thing. Yeah, it's not just a perception thing, though, right? Like, let's say, going back to Nvidia. Let's say we're like, Nvidia is not doing well. I'm not feeling confident, but I want to pull my money out of it. But then there's a secondary level of perception to it. So I'm then like, everyone thinks Nvidia is gonna do crap, so everyone's gonna probably think it's gonna go down, so I'm gonna go the other way. Do you get what I mean? So like, people start making secondary, tertiary kind of assessments on it. So you're not even sure. So when things should be going down, for example, they go up, because people are not just betting on the intrinsic value of a company. They're not thinking it's unvaluable, it's gonna go down. They're thinking, what is the other set of stockholders gonna do as well? Because you're essentially betting not just about the company's performance or whatever, but you're literally you make money in the stock market based on how other people react. Right? That's what the stock market game is. It's about what other people do.
Perception,
and it's insane.
And I think that's a great way to wrap up our deep dive into the stock markets. If you enjoyed this episode, drop a comment below. Let us know, show us some love. If you want us to do another episode on this, we could do multiple episodes on the stock market.
Yeah? If you got specific things you want us to talk through, if you've got things we missed out on, hit us up.
Blocks to bags. I'm your boy Seb.
I'm Micky.
And we out.